Good morning. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Efficient Market Advisors. We are a business of Cantor Fitzgerald Investment Advisors. This is our weekly economic and market commentary for the week beginning today, May 21st, 2008. The presentation you are about to see and/or hear has been prepared by EMA for use with both investors and financial advisors, each of whom are expected to make their own investment decisions. Nothing contained in this presentation should be treated as investment advice or a recommendation for the purchase or sale of any security. With that, let's begin. Sort of a mixed week in equity markets last week. Emerging markets were down the most on fears of higher U.S. interest rates. Large cap developed markets, both internationally and domestically, were down slightly, but we saw strength, a little bit of strength in mid cap domestic names. But the S&P Small Cap 600 Index was the shiner, up 1.6%. On a year-to-date basis, that's the case as well, 7.5% on a year-to-date basis for small cap U.S. stocks. Interestingly, last year, small cap U.S. stocks underperformed while the name of the game was large cap. Long-dated U.S. Treasuries down about 1.6%, bringing the aggregate bond index down about 0.5%. And on a year-to-date basis now, fixed income is mostly negative, the exception being shorter-term investment-grade floating rate debt, up almost 1%. Commodities continue to inch higher as well, up 0.4%. And for the week ended Thursday, the global hedge fund index was up about 0.5%. Let's get into the economic data and what the implications might be for our portfolios. The Empire State Manufacturing Index bounced back from somewhat weaker numbers in April. Back in April, there were fears of a trade war that seemed to permeate some of the survey respondents. But in this case, in May, the survey rose to 20.1. That's from 15.8. All of those numbers are good. Anything above 0 signifies that the manufacturing component of the New York State economy is rebounding. Expectations rose from 18.3 to 31.0, suggesting increasing confidence and further gains possibly ahead. Moving on to retail sales, while they were moderately disappointing, both February and March were revised higher. April retail sales rose 0.3%, 4.7% higher than they were a year ago. Speaking of retail sales, the secular trend of moving from brick and mortar to e-commerce or online sales is not abating anytime soon. First quarter e-commerce sales rose 3.9%, $123.7 billion, 4.5% year-over-year growth for total retail sales, but e-commerce is up 16.4%. That shows you that this is a secular trend and a movement not expected to end anytime soon. In fact, it's done a little bit of damage to the real estate investment trusts, which tend to hold a lot of retail buildings in their portfolios this year. Of course, we expect them to adapt and repurpose a lot of those properties over time. Perhaps there'll be a buying opportunity some point in the real estate investment trusts because of it. And let's talk about housing. National Association of Home Builders Housing Market Index, the sentiment index of builders, was the first rise since December, so we've reversed that declining trend. All of the numbers, though, of course, are very high, and the sentiment reading here is close to an 18-year high. Low unemployment, a shortage of inventory, bigger paychecks, bigger take-home income because of the reduction in some of the withholding rates, increased activity. Also, with interest rates starting to kick up, but still relatively low, it's causing, I think, a little bit of an increase in activity and income. However, home builders did report that labor prices on the rise and a rising lumber costs were dampening their expectations somewhat. But they continue to start and permit for new homes. Housing starts were a little bit lower than the 11-year high, came in at 1.287 million. It was due primarily to an 11.3% fall in multifamily starts, but single family up just a tad. Building permits also dropped, but still at a very high level. Housing market recovery is expected to continue. Moving on, last week we also got a report on April industrial production and capacity utilization. And what we're seeing is that this capacity number continues to go higher. We've had 3 consecutive months of strong growth in industrial production. To me, this seems to suggest that we're going to have a very meaningful pickup in the I. The formula for GDP is C plus I plus G plus X minus M. I is investment, otherwise known as capital expenditures. And that has been slow to recover. I think it's one of the reasons why our government put in the Tax Reform and Jobs Act of 2017, Tax Cuts and Jobs Act of 2017, they put in this provision which allows businesses to fully expense capital expenditures in the year in which they occurred. That went into effect in January. We expect to see industrial production and capacity utilization continue to trend higher. That will suggest that this meaningful impact on capital expenditures is likely to come up in GDP reports in coming quarters. Jobless claims continue near historical lows, although they were up a little bit on the week to 222,000. The 4-week moving average fell a little bit, and it is just off the lowest since December of 1969. Philadelphia Fed survey, a lot like the New York survey, had a nice bump, really spiked from 23.2 in April to 34.4. New orders surged. Employment also rose and remains very, very strong. Moving on to the sort of the wrap-up almost of earnings season. It was a great earnings season indeed. We saw significant earnings growth across the board. It's interesting that it was dragged higher so much by energy. Energy can fluctuate greatly because of the price of oil. We all know that the price of oil has gone up, and the price of gasoline, of course, has gone up as well. We're seeing that at the pump. And just like that sort of dampened earnings growth a year or two ago when oil prices were dropping, it's sort of spiking it. So we take that energy growth not as a secular trend of 95% growth. We look at it more as it's a growth in the price of energy, and we want to look through to the other sectors to make sure the economy, in fact, is doing well and earnings, in fact, are doing well. And as you can see, looking at the other 10 sectors, it's doing extremely well. Only one sector, that's real estate, did not experience double-digit earnings growth. It still had strong earnings growth at about 8%. Overall, the S&P 500 earnings growth for the first quarter is coming in around 23.5%. We've got 352 out of 464 reported companies exceeding earnings expectations. This week, it's a light week for economic data, particularly nothing on Monday or Tuesday. Here it is Monday morning, and we're seeing a big market rally based on a reduction of trade tensions with China, between China and the United States. Come Wednesday, though, we'll get into the market, that's M-A-R-K-I-T, both manufacturing and non-manufacturing PMIs, as well as new home sales. Minutes from the Fed meeting in May. Weekly claims, house price index, and home sales on Thursday. Durable goods and consumer sentiment on Friday. So none of these, I think, are major market-moving data metrics this week. We are primarily through earnings season. So my guess is this week things will be driven more by geopolitical events as they unfold. As always, thank you for tuning in. We'll talk to you again next week.